Welcome back to another episode of Equity Mates Investing, the podcast where we explore what's possible in the world of investing. If you've just joined us, a massive welcome. My name is Bryce, and today we're looking at one of the world's hottest commodities right now. We have another Pimp My Portfolio submission, and we review the latest book from Morgan Housel. To chat through it, as always, is my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Another big one. Pimp My Portfolio is back for the second time.
Yeah.
I can't wait to get into that. But before we do...
This is not financial advice.
Yes, now while we are licensed, we're not aware of your financial circumstances. Any information on this show is for entertainment and education purposes. Any advice is general. But Ren, let's hit it.
News and markets.
All right, Bryce. Well, two bits of news that we have been watching and that we want to talk about in this section. First of all, as you said, the world's hottest commodity, and no, it is not lithium. In fact, that's one of the world's coldest commodities at the moment. But also Nancy Pelosi's latest stock trade.
Okay, give us some context here, though.
Well, which do we want to start with?
Let's go Nancy Pelosi.
Okay.
And for those that have just joined and have no idea who she is or why we find this interesting, what's the deal?
So Nancy Pelosi is one of the more senior Democratic politicians. She represents a district in California in the US Congress. She has been the Speaker of the US Congress before, so like a very senior politician. But the reason that she is interesting in investing circles is for her stock trades. And I think her husband actually manages the portfolio. When Nancy Pelosi entered politics in 1987, her net worth was $3.5 million estimated.
Okay, so
She earns a salary of $223,000 a year, maybe a bit more when she's Speaker of the House. But her net worth today is $115 million. And the reason that it is because of some incredibly well-timed stock trades. The US political system, politicians can trade stocks, and they have to report their stock trades so you can see what they're doing. But there's obviously questions of what information do they have and how do they trade on the back of it. And it's not just Nancy Pelosi. This is a system that is incredibly problematic. But that is a conversation for another day. We're not going to get into US ethics reform on this podcast.
No.
What we are going to do is have a look where Nancy Pelosi put her money.
Sorry, when did you say she started politics?
87?
87. Okay, cool.
Are you doing a compound?
Yeah.
What do you
Okay, so she's actually just underperformed the market, so sucked into her.
What?
She's done a CAGR, compound average growth, of 9.8%.
Show us the inputs.
3.5 million to 115 over 37 years.
So are we saying what?
So we're saying
No.
that you can become a multimillionaire. That's what this whole show's about, I guess.
You just have to start with 3
Just
million.
if you start with 3.
Well, then I guess we're saying that all this noise around Nancy Pelosi, she probably just bought the S&P 500.
Yes. Well, she hasn't, because you were just about to launch into what she's bought.
There's some quite famous Nancy Pelosi trades, Nvidia and a few others. But I think that puts an incredibly different context on...
Well, let's close out that bit first, which is that she allegedly used political connections and I guess information to place
some well-timed
some very well-timed stocks.
And we should be really clear, like, it's not just Pelosi. Some of the most egregious ones were around COVID. Like, there were stories of different senators and Congress people getting closed-door briefings at the start of COVID and then, like, dumping stocks. And anyway, like, it's a system that needs reform. But Nancy Pelosi has bought Palo Alto Networks,
Okay,
which
so
is
we're buying.
which is a Silicon Valley cybersecurity fund. If you own the BetaShares ETF hack, it's one of the bigger components of that. It's been a really good performer, but it sold off recently because it did worse than expected in earnings season. And the commentary from the CEO was they thought they were going to land some government contracts because the government is beefing up their spending on cybersecurity, but they didn't materialize and they weren't as big as they expected. And then Nancy Pelosi buys a whole bunch of options.
Classic.
So take
Watch
from
this
that what you
space.
will. Anyway,
Anyway,
that's something that's come across that's making news, and I don't know if there's much to be said.
Well, let's move on. But I think the key takeaway there is it just goes to show the power of compound. If you just have your money in the markets for up to 40 years,
3.5 million,
3.5 into 115 at 9%. That's literally taking the S&P for the last 40 years. Anyway, that's the beauty of being a retail investor. We can get those returns. But let's move to the world's hottest commodity, Ren, that isn't lithium or gold, but is absolutely booming right now.
Yeah,
Cocoa.
and pushing up inflation.
Yeah.
Cocoa.
Cocoa.
Yeah, the key ingredient in chocolate. According to Rabobank, your favorite chocolate treat costs an average of 10.3% more than it did a year ago. And if you're not seeing that in the price, you might be seeing that in the product weight.
Definitely. Tim Tams.
Shrinkflation.
Definitely.
Yeah. What, less Tim Tams?
I bought a packet the other day, and admittedly it's because of the type, but there's now 3 main types of Tim Tams. Original, double coat,
My go-to.
and triple coat now. Yes,
way.
triple. Now, original has 11 in it.
Yeah.
Double has 9.
Yeah.
Triple, I think, is 7.
Oh, well, that maths works.
Yeah, but when you open the packs, you can see in the triple, the spacing between them is huge. They could easily fit another one in there.
Okay.
So not quite shrinkflation, but nonetheless.
So here are the numbers. Cocoa prices have more than doubled since the start of 2023. But since the start of 2024 this year, they're up more than 40%. And they've hit an all-time high of about $5,500 per metric ton.
Wow. Why?
Weather in West Africa. So 3/4 of the world's cocoa is produced in West Africa. 2 countries alone, Cote d'Ivoire and Ghana, contribute about 2/3 of the world's output. There's been drier weather. A lot of people are pointing to both El Nino and climate change. But it's led to a massive deficit. Rabobank forecasts a 3rd consecutive annual cocoa deficit. They estimate it's about 160,000 metric tons in 2024, which, according to them, hasn't happened before, at least in the data that they've got going back to 1960. So a catastrophic shortage in chocolate.
Wow. To be honest, I have noticed it. My Cadbury Black Forest has gone up in price. Love a Cadbury Black Forest.
I don't think I've had it.
Oh, you know the one with the little chocolate bits and like the raspberry like jelly lolly?
Yeah, okay.
So good. So good. And this is why it matters.
Yeah.
This is why it's making the top of the segment because it is hitting inflation and obviously price inflation.
Yeah. Now, Hershey's CEO came out and said that the chocolate maker's earnings growth will be flat this year due to historically high cocoa prices. They reported 4th quarter profit of about $350 million, which was down about 12% from a year ago. And I was surprised that an American chocolate maker was feeling the effects because I don't think American chocolate has much cocoa in it to begin with.
What do you mean?
It's just all like just
Like
sugar and...
Yeah.
American chocolate not as good as British or Australian chocolate.
Those that are hurting are the crazy people out there who buy the 90% Lynch dark chocolate.
Yeah. Who think they're better than us.
Yeah, that's going to be going. This cocoa input in that would be huge.
Yeah. Now, of course, Wall Street are trying to trade it. Hedge funds have been piling into the cocoa market since the end of last year, which is really only adding fuel to this fire because they're bidding up the price as well as they're trying to speculate on the commodity, which is also facing a shortage. Estimates are that speculative traders have amassed almost $9 billion in bets across London and New York futures exchanges.
Classic.
So yeah, they're
Money to be made.
They're betting prices are going to rise. A lot of the chocolate makers are predicting shortages and dealing with it. But yeah, the world's hottest commodity, it's cocoa, and it's going to affect. Well, it sounds like it's going to affect you more than most.
I was just going to say, to wrap up, if anything, this is a positive for me because it's going to mean I buy less chocolate.
Do you think how dramatic does the price rise need to be?
I think it's at a point now, I only buy on special. Let's put it that way.
Oh, really?
Yeah, and I don't really buy it that much, but yeah, Maybe I do. But anyway, Ren, let's move on. We've got Pimp My Portfolio. All right, Ren. Well, it's time for...
This is Pimp My Portfolio. Pimp My Portfolio.
I love it.
Yes, the sting
Love it.
gets better every time. There's a level of excitement here because this is fast becoming one of our favourite segments here at Equity Mates. Pimp My Portfolio is back.
It is back, and we have joining us again in the studio our expert for Pimp My Portfolio, Luke Larrative. Luke, welcome.
Bryce, Alec, how are you?
Good. Excited.
Best new sting, I reckon. Just throwing it out there. I might be a
Yeah.
bit biased, but I reckon it's the best of the new stings.
Yeah, we're pretty happy with it.
Yeah. Pretty happy with ourselves here, actually, mate.
Joining us online is Romero. Romero, welcome.
Thank you very much, guys. Hi, Bryce, Ren. Thanks for having me here.
Anytime. Luke's had a look at your portfolio. He's got a few suggestions, but we'll start, as we always do, by just giving a high level on how your portfolio is currently constructed. Ren, what are we looking at?
Yeah, so Romero's got he's got a few holdings. He's got a few ETFs and then some stocks. So I guess the core of the portfolio is a Vanguard Australia ETF and a Vanguard MSCI International ETF. Then there's a couple of thematic ETFs as well, BetaShares Crypto and BetaShares Video Games and Esports. So those ETFs together are about half the portfolio.
Mm-hmm.
Then on the individual stock side, we have some big, well-known companies. Commonwealth Bank's in there, Qantas is in there, Nick Scali, Flight Centre, and then some smaller companies, including one that does the rounds in the Equity Mates community, BrainChip Holdings. I'm sure Luke will have some thoughts on that one.
Nice. All right, so that's the...
Let me get my stick.
Luke has gone away and thought long and hard about naming this portfolio. So drum roll, Luke, what is the name of Romero's portfolio?
It's called the Confused Core Satellite.
Okay. The confused...
And why is it confused?
Like weightings and construction and... Yeah, just how he's set it up. But we'll get there.
Yeah, we'll get there. A bit to unpack there. So, Romero, what is your response to Luke's name of the confused core and satellite?
No, I completely agree, guys. Couldn't be better. Put it that way.
Well, hopefully by the end of this session, it'll be a little less confused. So I guess where do we start, Luke?
Okay, so I'm going to assume that you want to have all your money in equities. I'm not going to bother talking about fixed income and other stuff that you can invest in. You want all your money in equities. I think the Romero's taking sort of this, like we said, this core kind of approach where you've got some core ETFs and then you're trying to choose some stocks on the outside. And I think that's fine as a general comment, but just the way he's done it's a little bit strange. So you've got 12% in Vanguard Australian shares, like for example, and then you've got 18% in CBA, Bank of Queensland and Qantas, like sort of large cap Aussie share picks. I would say like figure out what what the core is going to look like, whether that's a multi-asset ETF or a mix of geographic type of broad-based index following ETFs, low cost, and then find some sector ETFs and companies on the outside, but get the weights right. So if it's going to be 50% core, fine, and 50% non-core, that's fine. But then, how do we deal with that sort of non-core part? And that's where maybe thinking something along those maybe 5 to 10% kind of max per individual security or sector ETF.
Okay. So, Romero, how to this point have you gone about actually thinking about constructing your portfolio?
Yeah, so like I said, it couldn't be better. The name of the portfolio. So I'm reasonably new on the investing journey. I started 2 years ago. I just recently started to invest on the VGS and VAS. So that's why the percentage is still low. My idea is get VGS and VAS and a few other ETF as a core portfolio, and have a few satellite ones, especially the ones that it's not doing very great at the moment, which was the individual stocks that I bought was when I start my journey in investing. And as everyone, I believe that I was trying to be smart and beat the market. And yes, so the market
we've all
showed me
been
that
there.
it's not that easy.
Yeah, I don't know why retail investors and sort of non-advised people have such an aversion to investing with active managers. So I know this is sort of talking my own book a little bit, but okay, you want to have a core satellite strategy. Why wouldn't you have a core satellite strategy with managers rather than having
fees?
Well, it doesn't matter. You're going to get better. Like, no offense, Romero, but like any professional manager is going to do better than this portfolio.
Well, no, I think
of satellite stocks.
I think that's the distinction with satellite stocks. Completely fair comment with your core low cost index tracking portfolio. That's where Bryce's fees comment comes in, and there are active managers that beat the market over the long term, but there are plenty that don't.
Yeah, for sure. And I'm not saying finding those managers is necessarily the easiest thing in the world, or getting access to them and minimums. And I'm not saying it's not without issue. All I'm saying is that I think as a general comment, people are, I'm going to go and choose these stocks and I'm going to beat the market, and then they don't benchmark their returns, they don't compare themselves to other managers, and they go, well, I just like this company, so I'm going to buy it. It's like, well, okay, cool. Like, your money, do whatever you want with it. But if you're just trying to generate the best possible returns for yourself with a sort of systematic, long-term, sustainable process, I would personally think that picking, one or two high-conviction managers who are going to own, 20, 40 companies each kind of thing, and then just owning those two on the outside of your core kind of makes a lot of sense if you don't think that active managers can beat the benchmark at a core level. But I would not agree with either of you on that. And don't make me get the data out.
No, there are some that can. You just have to find them.
Yeah, you got to know. And look, there's certain processes, and I've written articles recently about this on Livewire about how to choose managers and how to think about what works in different sort of sectors and asset classes. So there's definitely some rules to live by there a little bit too. But yeah, look, I would just be sort of thinking about, okay, well, if I'm going to pick stocks and sectors and I'm going to have my core, Romero, and, think about what kind of companies you want to own, and then think about getting the weights right. Maybe reduce the number of fracks so that you're a bit more concentrated on things where you can actually slowly learn about the company and gain an edge.
Mm-hmm. Yeah.
I have a question for you then, Luke. So Romero has VAS in his portfolio, the Vanguard Australia ETF. I think it's the top 300 or
I think so,
something like that.
Something like that.
But then also has Qantas, CBA, a lot of big Australian names that are likely to make up a large chunk of VAS itself.
Yep.
And, Romero obviously started the journey by going down the individual stock route. But I imagine a lot of people are in this position where there's a bit of overlap with the individual companies and your ETF. What is the general comment there if you're looking to reduce your positions?
Yeah, I mean, it's pretty simple. Is you sell the stuff you don't want to own anymore and you buy the stuff that you do. Now, you'd have to buy something new. I know that's sort of a smart-ass answer, but if you think, okay, well, I've got some Qantas stock in my VAS holding. I've got some, Commonwealth Bank shares in my VAS holding. Well, I can sell those, and that's going to throw up X percentage of my portfolio that's available, and I'm going to reallocate that based on my ideal, portfolio setting. So I think what we're hearing doing these calls, like third one of these now, is very much the same. People come into it with a kind of gambling mentality of buying individual stocks. They don't got really no idea about what's going on at the company, what the market expectations are, all the stuff you're supposed to know to be able to make an informed decision. And then they realise that doesn't work when you don't know what you're doing, and they go to ETFs, and that's great. Like, you're doing the right thing, but you've got to do it with all your money to get the maximum impact out of it.
I think there's perhaps a fairer way of characterizing early investment decisions, which is a lot of people don't know about ETFs or how they work, and so people start with individual stocks because
it's more well known.
That's what people think is available on the stock market. So they buy well-known Aussie companies.
Was that your situation, Romero?
Yeah, so pretty much when I started, I was having any clue about ETF or never heard about ETF. So I went directly to a stock. And then when I started studying and hearing podcasts and hear equity mates and search on the websites. So I started heard about ETF, and then that's when the coin flips, and I said, "Whoa, okay, maybe that's the approach now."
So, Luke, the question that I'm sure a lot of Aussie retail investors have been waiting to hear asked is BrainChip holdings. So I guess, we've covered off some of the bigger stocks in the individual stock part of the portfolio. Let's move to some of the smaller names. So there's Catapult, which has been a popular stock recently. BrainChip's in there. How are you thinking about some of the smaller names here?
Yeah, I think whenever you're investing in small companies, like, you've got to have a really clear understanding of like the business, the product, the people, and how the capital is going to get spent, because you're essentially in a business situation where we've given them $100 and they're going to run, that $100 is going to disappear at some point because they're not profitable and they're not generating money. So look, I don't follow BrainChip super closely. I don't know a whole lot about it. It's not in my wheelhouse at all. And I think anyone who's reasonable and rational with themselves would probably argue that it's not in their wheelhouse either.
Romero, is it in your wheelhouse?
No.
So, like,
It was.
Look, I'm not saying it's a good company, a bad company, it's going to do well, it's going to do poorly. I'm not saying any of that. I don't know. What I'm saying is that when I'm looking for companies, I'm looking to invest in things that I understand and know better than everybody else. Yeah. Like, so, that is where you're going to find an edge. That is where you're going to find value. That is where you're going to be able to understand a longer-term investment thesis when everyone else is looking at the short-term noise. Yep. And so try and find, if you're going to invest in single shares, try and find scenarios. If you work in metal processing and, your customer is Sims Metals, well, maybe like have a look at their company, and if you think they're going well, buy it, and if you think they're going poorly, don't buy it or short it. I think investing around stuff that you've got a real tangible kind of understanding of in a practical, nitty-gritty kind of way, that's where the value is and the money is.
Yeah, nice.
So, Romero, do you have any final questions for Luke?
I guess in terms of the stock and ETF, look, I just want to understand a bit more, if you can provide some general information in terms of what would be the wages, the ideal percentage.
All right, so if you think about your asset allocation is going to drive 90% of your return. So what I mean by that is how much money you've got invested in growth assets versus in defensive assets. And what I mean by growth assets is shares as a general comment. And what I mean by defensive assets is bonds as a general comment. So you need to think about that as a start point. If you want to go and get an idea of, what the appropriate sort of weights are for a risk profile, like a high growth, a conservative, a balanced, well, go and have a look at your industry super fund, or go and have a look at one of those multi-asset ETFs we're always banging on about in this segment, to give you an idea of how professionals are weighting portfolios, growth and defensive, or equities, bonds, and other stuff. So, for you, I don't know what's going to be the appropriate weight that how that would play out. But assuming, your current portfolio is sort of pretty high growth and pretty 100% equities, maybe like 40 to 60% global equities, 30 to 50% Australian equities, diversified ETFs, something like that. And then maybe 20 to 40%, you could do some stock picking if that's what you're interested in and want to do. Some of your stock picks have been good. Like, you've got a pretty good strike rate at the moment if you've held these for the last sort of 12 months. Doesn't sound like you have, but, regardless, and 5 to 10% per company kind of max, more like 5, more like 3.5. That's kind of the number that I would be thinking about, and just kind of keep it to a small list of your pet stocks that really well, you follow closely, and you can keep an eye on. Doesn't mean that you don't make changes, but I'm not a big advocate for high trading, high turnover. You might just be topping and tailing. It's kind of how we run our portfolio, based on valuation. And yeah, try not to get distracted by the shiny things in the corner of your eye, when Bryce is trying to pitch you brain chip or
Never.
whatever else. But, some other nefarious podcasters, selling you down the river on something, or you're on, the dreaded hot copper.
So just for people listening, just repeat those percentages that you had for global equities, Aussie equities, and then individual stocks.
Look, and like I said,
It's super general.
You can do this 15 different ways from Sunday, but look, 40 to 60% global equities, 30 to 50% Australian equities. Then you can have the net, essentially, which would be 20 to 40 in some stock picking. In that stock picking, kind of depending on your conviction. Now, if you know a shitload about a company and you think you're way ahead of the curve on it, no, not what you read on the internet, what you already know from other places that aren't the internet.
By definition, if you read something on the internet, you're not ahead of the curve.
Correct. That is the correct answer. So, that would be, you'd have lower conviction in that kind of idea versus, say, like if you'd been working in the, private equity investing in healthcare for 20 years and now you're trying to invest in healthcare companies. Well, you're going to know a lot about how they run. So high conviction, like 5 to 10% as a starting weight. And then if it gets over 10, you're going to trim, you're going to be forced to trim that and reinvest it in something else. Hopefully something in that core part, You're not
a big let your winners run guy?
I am, but you need to have risk management is important. So whatever you're going to set your parameters at, maybe it's 15% you're going to have to trim, or 20% you're going to have to trim. I don't care. Just have a rule, have a process, and keep it because building continual conviction in stuff can lead to significant portfolio holdings, and a small error can lead to big financial impacts. And I think as a non-professional investor, the consequences of that can be pretty dire.
Well, on that ominous note, Romero, thank you for joining us. We hope you got something out of this conversation and have some general thoughts to go away and think about.
Definitely. Yeah, no, thank you very much, Luke, Ren, and Bryce for all the advice and the chat. Really
general
advice.
General advice.
Yeah, general advice. Appreciate that. Certainly, I will study a bit more and make the necessary change according to my view. That's good talk. Appreciate it.
Awesome. Well, thanks, Romero. We very much appreciate you coming on.
Okay. Thank you, guys.
Alrighty. Bye-bye.
See you, Romero. Bye.
If you would like to book in a time with Luke to review your portfolio, have these sorts of discussions with him in a bit more detail, discuss the markets, or just get him to help with your financial goals.
Well, and actually
broadly.
get personal advice.
And get personal advice.
I can't guarantee everyone's going to I can give personal advice to everybody, but I'll try.
Yes. Head to equitymates.com/advice. You'll find a form there where you can select Luke's name and his booking calendar will pop up, and you'll be able to book directly in with Luke. I would highly recommend that if you are looking for some professional advice on your portfolio. Equally, if you'd like to come on Pimp My Portfolio, submit your portfolio at equitymates.com/contact. All those links will be in the show note. But Luke, as always, it's been an absolute pleasure.
Pleasure, gentlemen. Love being here.
Welcome back to Equity Mates. This is a podcast that explores what's possible in the world of investing. We've covered off the hottest commodity, cocoa. We've had our Pimp My Portfolio. And now it is time for...
Book Club. Ren's reading the book, so Bryce doesn't have to.
That's it. I'm getting the spark notes for books that are coming across Ren's bedside table at the moment, and I will bring one, I am sure. But today, Ren, what have we got?
So we are going to be talking about Same as Ever by Morgan Housel. People may be familiar with The Psychology of Money, Morgan Housel's first book.
Was that his first one?
I actually don't know. First book I came across.
Yeah.
I think so. Yeah. A lot of the stuff you see is just the two books that he's written. Psychology of Money is up there with my favorite investing book. It would be at least on the podium for me, probably number one. Like if you haven't read Psychology of Money, highly recommend reading it. And I am buttering Morgan up because I'm not going to be as positive about this second book. But yeah, if people don't take what I'm about to say as any indication of the quality of the first book, because it's worth reading. This book, on the other hand, I think you can probably skip. So I'll get into it. The premise of the book is timeless lessons on risks, opportunity, and living a good life. And what he tries to do is pull out 23 stories or 23, I guess, like facts or phenomena of the world that don't change. He says that too many investing and economics books focus on things that are changing and will change and have changed.
Okay.
But he wants to focus on things that don't change.
For
Now-
the purpose of like money management?
Oh,
Or just
yeah,
like
but it gets
putting
into
things in
life.
perspective?
There's a bit of biology in there.
Okay.
I'll get to that.
All right.
And the premise is that like these are the things that you should sort of base your life and your finances and everything around.
Okay.
And I think so. There's 23 chapters here, 23 things that don't change. I think you can largely split them up into two groups. One is like things about people that don't change, and the second is things about the world that don't change. And I think a lot of it is pretty harmless and I think a lot of it's pretty good. Things like incentives rule the world. That's something that people are always responding to incentives, and that's how you can understand people. Like things about people that never change. I think a lot of that category makes sense.
Yeah.
But my gripe with this book
Nice.
is when he starts talking about things about the world that never change.
Okay. Hit me.
And there's certainly things about the world that never change, but I don't think Morgan has done a great job of identifying them or proving them.
Okay.
Instead, these chapters take the following three-part structure. Firstly, a big normative statement. This is always true. Then secondly, a number of examples from economics, psychology, or biology that quote-unquote prove that normative statement.
Okay.
And then the third part, how we should behave given that big normative statement is true. But here's the problem, Bryce. For almost every chapter, I could find competing examples to the examples that he gave us. You can't just cherry pick a few examples and say, therefore, this big normative statement is always true. So let me give you two examples from two different chapters that I think step through where I think this book fell a little short.
Okay.
First chapter that I'm going to talk about, overnight tragedies and long-term miracles. The big normative statement is, good news comes from compounding, which always takes time. But bad news comes from a loss in confidence or a catastrophic error that can occur in a blink of an eye. That's a quote from his book. So he's saying good news takes time to build up and be realized, whereas bad news always comes quickly. The examples he gives, 3 examples. First of all, heart disease has fallen an average of 1.5% a year between 1950 and 2014, which means that heart disease has fallen more than 70% since the 1950s. That good news has compounded over a long period of time. The second example he gives is that GDP grows at an average of 3% a year, which means that over a long period of time, GDP has grown 8-fold in the past 100 years. Good news takes time. The final example he gives was a little strange about life and death. He says for life to exist, tens of billions of individual steps have to go right in the correct order to create a human, but only one has to happen to cause its demise. And again, that's a quote that starts off that section or that example in the book. And so his takeaway then from those examples is to be long-term optimistic. But my gripe with that is, as I was reading it, there are plenty of examples that cut the other way. The most obvious of a bad news that hasn't happened quickly, but has compounded over
Climate change.
Climate change.
Yeah.
Just a classic example of inverting your heart disease and GDP and taking small percentage change year after year after year,
you're
compounding into something catastrophic.
Yeah.
But there's also plenty of...
And also like alcohol compound time and time again on your body.
Yeah, smoking. Yeah. Like there are so many examples. But there's also good news that just happens out of the blue. You know, scientific breakthroughs. A lot of them are accidental things that happen, that there's no slow compounding over time. Winning the lotto happens.
Done.
You meeting your future wife at Mooseheads on a night out.
Yeah, that was... Yes.
Just happened. There was
That's
no big,
very true.
There was no big lead up to
There
that.
wasn't- yeah.
Good things can just happen and bad things can happen slowly in the same way that good things can happen slowly and bad things can just happen.
Yeah.
The normative statement is things happen.
Things happen. Yeah.
But like he hasn't proven. So
Things
anyway,
happen.
so that was one example where I think you can't. The normative statement is too big
Yeah.
and too broad, and not proven by the examples.
Yeah.
I'll give you one more example and then we'll pull me out of this rant.
Okay.
So another example, another chapter, too much, too soon, too fast. And the quote, just kick it off, a good idea on steroids quickly becomes a terrible idea. And so the premise of this chapter is if something grows too quickly, it will become weak and die. If something grows slowly, it will be stronger and stand the test of time. He has 4 examples to prove his point. First of all, Robert Wadlow, the largest human ever known, he died at 22 years old and was almost 9 feet tall because his body was just a mess because it grew too quickly. His organs couldn't keep up, his joints couldn't keep up. He grew too quickly and he died. Second example from the stock market, Starbucks grew too quickly in the 1990s and 2000s. It had 425 stores in 1994. By 1999, it was opening 625 new stores a year. By 2007, it was opening 2,500 new stores a year. It grew too quickly, had to rationalize during the GFC and beyond. It closed 600 stores in 2008. It grew too quickly. It got weak. It didn't die, but it had to sort itself out. The third example, young tree saplings. When they grow in the shade of bigger trees, they grow slowly because they don't get a lot of sunlight. That leads to dense, hard wood. But if they're in an open field with no shade, direct sunlight, they grow more quickly, they grow faster, but they grow soft, airy wood, which becomes a breeding ground for fungus and disease. You can see what we're going here.
Yeah.
Slow growth, strong.
Yeah.
Fast growth, weak. Fast growth, weak.
Yeah.
The final example, 2 identical groups of fish. One is put in abnormally cold water and one is put in abnormally hot water. The group in hot water grows faster. Then you put them back in the same temperature water and they end up being the same size. But here's the interesting thing. The group in the hot water will die sooner, about 15% sooner, because they grew too quickly.
Okay.
And so those 4 examples are used to prove the case that if something grows too quickly, it becomes weak and dies. If something grows slowly, it will be stronger and stand the test of time. And so the outcome is grow slow. Don't try and grow too quickly or too big. But again, it's just like cherry-picked examples that prove this normative statement. I can think of plenty of examples that cut the other way. There are plenty of examples where things have only been successful because they grew quickly. In the stock market and company context, the most obvious example is all of these winner-takes-all startups. Uber. If Uber had focused on growing slowly, we wouldn't be taking Ubers. We'd be taking
taxis or competitors
or DDs or Lyfts or Olas or something else. Like sometimes you have to grow quickly or you don't make it. Slow growth doesn't always make you strong. Sometimes slow growth makes you out of business.
Yes.
But it's also just like an example of hindsight, like ex post facto rationalization. Something has happened and then you're doing the analysis afterwards. Because what is to say is too fast growth? Like, I'm sure we could find other fast service restaurants or other retailers that have grown at a similar store growth to Starbucks, but they sustained that growth.
Yeah.
And so what's to say that like what level of growth is too fast, quickly until after the fact?
Yeah, I mean, it was hit by the GFC 2008. Of course, it's going to have to rationalize. But like, if that didn't happen, maybe it wouldn't have even been an example.
Yeah.
Yeah.
So again, it's just like, I don't think any of these ideas are wrong. I just don't think the logic is there that like these handpicked examples prove these giant normative statements about the world.
Yeah.
And so that's my gripe with this book.
Nice. Well, if you want to read it, it's called Same as Ever, Morgan Housel's second. What's the byline?
Timeless lessons on risk, opportunity, and living a good life.
There you go. Yeah. So 23 of them.
Now, look, I'm being too harsh. Like, there's certainly some good takeaways from this book, and there's certainly some lessons that will make you a more thoughtful investor and, probably make you think about your life. But I just think be careful. I think it's a think about your life. Yeah. Don't take it as gospel for your life. Yeah. Because good things might happen out of the blue and bad things can compound over time.
Yeah, let's hope we win the lotto. So that brings us to the end of our episode today. If you have a book recommendation, head to equitymates.com/contact. We'd love to hear from you. If you'd like to submit to Pimp My Portfolio, same equitymates.com/contact. Or if you have a general question that is investing or money related, we'd love to hear from you as well. But Ren, that brings us to the end of today's episode. We will be back.
And the end of our chances of getting Morgan on this podcast.
Make sure you do read The Psychology of Money. Definitely a great investing book. But Ren, we'll pick it up next episode.
Sounds good.